And people are getting kind of nervous, as a Bullseye Brief founder and publisher and author Adam Johnson has been telling me. He's been fielding calls all night. Also, we have with us Flynn, Zito Capital Management, Capital Managements. There we go.
Plural.
Possessive plural. Doug Flynn. Good to see you guys. Tell me what's been going on. People are that scared, and what are you telling them?
Yeah, they are, Trish, and it's understandable, because you work so hard to save money, put it away, invest it in the market, and then all of a sudden this happens. But, the fact is, if you looked at the jobless claims this morning, Trish, they were the lowest in 45 years. In other words, the fewest number of people in the country in 45 years are filing jobless claims. What a great American story, the fact that we're all working, that we're spending money, that earnings are growing, that GDP is going to accelerate. The catch is that also probably means interest rates are going up, and we're just adjusting to the fact that we're having higher rates. But, it's understandable that people are nervous right now, Trish.
You believe
Yes.
the Atlanta Fed. You told me, because 5.4%, by the way, is what everybody at the Atlanta Fed is thinking we're going to get for growth in the first 3 months of this year. And I just want the viewers to understand
That's huge.
that is a very big deal.
Oh, my gosh.
A very big deal because, we were growing at 1.5% on an annualized basis there under the Obama administration for 8 years. So
Right.
what do you know?
So all
Trump's there and 5.4%. I don't know, but you think a 5 handle is quite possible?
So I've been saying 4%. It's amazing, actually, when I was saying GDP of 4% and the 10-year of 3%, which, by the way, I was saying about a month ago, and people said, Adam, you're crazy. Now, all of a sudden, we're at 3% on the 10-year, and the Atlanta Fed saying 5.2%. Incredibly powerful. But the fact is, that's what happens, It's like we all got lulled to sleep by this Fed that kept rates low for so long, and now all of a sudden everything's starting to percolate. It's like we've awakened and said, oh, wait a minute, this economy really is growing, and that is a wonderful story. So,
and does that take care of a lot? If you get a 5 handle on GDP.
Oh, my gosh. Yes.
Yeah?
That solves a lot of problems, Trish. All of a sudden, the government is bringing in more money because tax revenue is going to be higher. Our deficit isn't as bad. So maybe it's okay that they're spending this money that we've been talking about in the proposed budget. All of a sudden, people are going to be making more money than they thought. We're all about to get a raise February 15th. That's when the payrolls go up. So there's a lot of good stuff happening under the surface.
Adam, you always make me feel better. Let's go over to Doug Flynn, who's also with us here. And how are you thinking about this right now? What are you telling clients, Doug?
Well, I think you need to put it in perspective. Last year we had the maximum negative return during the year was like 3%. But if you go back to the 2 years prior, in 2016 we had an intra-year decline of 12%. In 2015 we had an intra-year decline of 11%. So that's a more normal downturn to be expected. And we've been saying, actually, even right here on some of your other shows, that earlier we were totally anticipating somewhere between an 8 to an 11% downturn after the year we had last year. That's very normal and healthy. And so we've actually had clients who are asking, how do we take advantage of this sort of short-term volatility as long as the fundamentals remain strong for the future, which they definitely do. And that's where there's the opportunity.
When you look at the market right now on a historical PE basis, what you see is we're still relatively cheap. We're 17, 18 times earnings right now.
How about
and
that?
Historically, you might be somewhere between 14 and 17. So it's not as though you can say, Adam, this market's super expensive, which you'd think when you're up around 24,000,
Sure.
It would be. But on a historical basis, it still is looking kind of
on a historical basis,
normal.
If you assume about $155 in earnings for the S&P this year, that's the number that I'm using, which, by the way, is growth of 18 to 20% over last year. That's pretty strong.
Wow.
Gets you to about an 18 multiple right now. I'm maybe 17 and a half, depending upon where you mark the futures. But I'm comfortable owning stocks at that level. I'm also comfortable with the Fed raising rates, because the fact is they're raising rates because of growth, because things are good. They're actually, they're finally doing something right. Which is raising rates in order to keep the economy from overheating. So I think we probably have another 18 to 24 months of runway for this economy. So I am buying stocks, and I'm trying not to look at my screens because sometimes it gets a little stressful. But
that goes back to that Xanax trip that Liz Clayman is pushing to try and get a handle on the volatility. Doug, what do you think looks attractive down at these levels?
Yeah, what we like to do is, and just furthering that point, is if you look historically, we're a little bit above normal valuation, maybe a little bit more in line with that now. But we're not one standard deviation outside of normal valuation. So that's when you start to get worried. And with future earnings growth and corporate earnings, it looks great. What we like to do is if you look at the areas, like look at all 11 sectors of the S&P and say, what performed the best over the last 12 years? You're going to find technology and some other areas. What we like to do is maybe move away from some of those crowded trades and look to the areas that have not participated. Look more towards the value side. Look for the things that have even negative returns over the last 12 months and add to those areas, especially if they're beaten down. That's where you're going to get more of the pop from here, not the ones that are up 30% over the last year, even after this adjustment. That's the way to do it.
Hey guys, I just want to show you this. This is the VIX, and it's a measurement basically of fear, and it's right now up about 13%. Yeah. So you see that people are getting rather nervous. What is the level right now? I know that was 31 earlier in the session. It's still there around 31.50. And when I say 13%, I'm talking about it for the entire week there, 1 week of trading.
Hey,
yeah, go ahead, Doug.
What's interesting about that is if you look at the VIX since like inception, like 1990, and look at it, there's only been like 7 other times that it's at this level adjusted. And the other 7 times prior to this that it's at that level are all the events that 9/11, the Great Recession, long-term capital management. There is nothing like that going on right now for these levels to be there. So it tells you that there's some opportunity brewing right now.
That's a great way to, because you look right now at what's going on and the fundamentals are good. It's not as though there's some kind of structural crisis on the horizon or a credit crisis a la 2008. I mean, things,
exactly.
I don't entirely understand the fear factor right now because, opportunity to be optimistic.
Well, you know what it is? We're adjusting to the fact that for 9 years, rates have been so artificially low that retirees had to actually go bag groceries. They couldn't afford to live on fixed incomes. And we're finally getting back to normal. And while it made doing things like buying houses and cars more affordable, which is good, and it stoked the economy and helped to get things going, the fact is, things are changing. We're getting back to normal. Rates are going up, and it's all positive. We're just adjusting to that concept.
I'll tell you one thing. My parents, who are retirees, will very much welcome some higher interest rates in their bank accounts, and I think a lot of retirees out there as well would as well. Adam, Doug, thank you so much. Good to have you guys here. Again, the market down significantly.